Okay, I started off tonight's show by saying that there were a whole lot of investment choices, and we're talking specifically tonight about stocks. So you can apply these concepts obviously to other classes of investment, as somebody pointed out, but I'm talking specifically about stocks tonight, and there are a whole lot of stock choices that you can make: stocks, options, mutual funds, REITs, direct investment stocks, selling long, selling short, whole lot of things. I'm saying that for the average investor who wants to get ahead and wants to make serious amounts of money, there's only two decisions that you have to make. And the two sets of decisions are concentrate or diversify. That's decision number one. And we spoke about that before the break. And the choices there are buy 4 or 5 individual stocks or buy a broad-based index fund. That's your two major choices, in my opinion, if you want to be a successful investor in stocks. The second that I want to talk about now, the second binary decision is I'm working for the principle that you're going to buy and hold when you do buy a stock or when you do buy an index fund. Either or. So if you pick your 4 or 5 stocks that you really want to buy, or you're buying your index fund, your choices here now are you're going to buy and hold, you're following those for the long run. But my question is this: when that stock or when that index fund starts to take a downturn, as inevitably will on its way up, you believe that the stock market is going to go up, or you believe that your 4 or 5 underpriced stocks are going to go up, they don't just go like that. Even though we had a 20-year bull run, they do go like this before they go up again, and might go down like that and go up again. So my question is to you, decision number 2 is, do you hold through those dips? And what do you do if you do decide to hold, or do you get out and try and time the market? And that's a very, very difficult set of decisions. And my next question is, if you're going to try and time the market, doesn't that make you a speculator? And the answer I'm going to give you in this video is no. You're not a speculator. So let's just take the situation that you buy a stock that you've done some analysis on, and you can analyze it through lots of methods. And I'm not talking about looking at charts and deciding it's underpriced according to some charts. If you want to do that, then by all means, to me, that's just witchcraft. And we're talking about technical analysis right now. I don't believe in technical analysis for deciding what stocks to buy. So listen to this very carefully. I don't believe in technical analysis for deciding what stocks to buy. I don't believe in looking at candlestick charting, shaking a dead fish over, 4 crossed bones or any of that other sort. To me, that's witchcraft. But I do believe in technical analysis for timing the market. So let me explain why we're not speculating if we decide to sell out of a stock that drops down, and if we decide to wait till it turns and then decide to buy back in, and why that's not speculating. The answer is this: you've looked at the stock market and the 5,000 or 50,000 available stocks, whatever the indexes are that you're looking at in whichever part of the world you're looking at. But let's say you're looking at the 5,000 large stocks in the USA, or even the 500 in the S&P 500. You analyze those 500 stocks in the S&P 500, and you decide that there's 1 or 2 stocks in the special industry segment that you understand that right now that you believe, by analyzing those stocks, and here's some ways to do it. You look at the balance sheet and you decide that the stocks are selling for less than book value. A great case of stocks that are doing that right now is some of the finance stocks. E-Trade selling for less than book value. Does that mean it's worth more than book value? Maybe not. Maybe fairly priced. But for whatever reason, you find stocks that are selling for less than book value that you think are worth book value or more. That's one way. Other ways are looking at earnings. And you see that these stocks are growing constantly for the last 5 or 10 years. Sales are growing. Profits are growing. Earnings are growing. And for some reason, the stock market has taken that stock and has grown the price of the stock in line with those, but has dropped. Bang, 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 bang. Or it's just simply the stock price has flattened off for some reason, and earnings have kept going like that. And now all of a sudden you think that that stock is in fact underpriced according to the market. That's the decision that you take. You're now not speculating, because what you're saying is you can buy that stock for $5, but you believe today, because that's what the market's selling it for, but you believe it's worth $10. So your plan is to buy that stock at $5 and hold it until it reaches $10. So now the market finally wakes up and decides to start repricing that stock up and up and up. It realizes it forgot about the stock, maybe there's a change in management, maybe that industry, maybe it was a tomato company and there's a tomato scare for a while and that scare's finished, whatever it is, the stock's now going up and up and up. You've now got a decision to make because on its way up, it's now gone to $6, $7. You still think it's worth a $10 stock. It's gone to $8.50, and now the stock is turning, and it drops to $8.40, $8.30, $8.20. What do? Do you hold or do you sell? This is what I'm talking about now. That's the binary decision that you have to make. Same thing goes for an index fund. You believe an index fund has been going up and up and up, and suddenly there's a correction in the marketplace like there is now, and it's starting to drop down. Do you sell out or do you hold for long term? And that entirely depends on what type of investor you are. I would say that your choices are this. If the stock is dropping, you can use technical analysis to decide if the market's going to continue selling. That may be a valid thing to do because technical analysis doesn't tell you why people are selling it. It just tells you that you think the stock is worth $10, but for some reason the big guys are getting out. Maybe you're better off getting out for a little while as well and seeing what happens. And that's a very valid thing to do. That's what I tend to try and do. The other way, the other approach is as it's dropping down, is to keep holding that stock. Let it drop down, because it means it's getting cheaper. The stock's on sale. You think it's a $10 stock, and now it's gone from $8.50 to $8.40 to $8.30, $8.20, $8, $7. Maybe now you want to buy some more of that stock because it's getting cheaper, and that's called averaging down. So it goes down, 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 and you keep buying more stock as it drops down. And then when it goes up again, you found that you bought some of the stock at $8.50, some at $7, some at $6, some at $5, and you write it back up again. That's the binary decision that you have to make. The only